All right, in a market thirsty for economic data during this partial government shutdown, the oil market is getting a data deluge of sorts. In just the last hour, we got this. The Federal Reserve Beige book, which assesses business activity in 12 regions across the country, had this glaring headline: energy firms are pulling back on investment due to lower crude prices. By the way, in case you don't know, Beige book surveys, they stopped calling people to get answers to the surveys January 7th. Now, why would that matter? Because in the weeks since then, we just got this. U.S. oil stockpiles showed a larger than expected drawdown in inventories, a loss of 2.7 million barrels versus the expectation of a drawdown of just 1.3 million barrels. Crude prices barely reacted today, but they sure have moved since the Christmas Eve low. And since then, they have climbed nearly 25%. But with supply cuts made by OPEC Plus, that's OPEC plus Russia, to the tune of 1.2 million barrels a day taking effect, is OPEC rearing its ugly head again? Let us bring in Chris Wright. He runs Liberty Oilfield Services, a pure play fracker. He's out in Denver. Chris, for a while there, it was starting to look like the OPEC cartel had finally lost its teeth and its mojo. But, you know, you can't deny that since they started paring output, we've seen price reaction.
Oh, absolutely, Liz. Prices dropped so dramatically in the fourth quarter. Saudi and Russia had ramped production up, thinking Iranian sanctions were going to end Iranian exports. Then we kind of gave a 6-month pause on that. Prices plummeted. They can't afford to have oil prices well below $50 a barrel. So, yes, they've taken action, and I think that's changed sentiment a bit. What
are you seeing on the ground in your world? You're a pure play fracker, and I'd love to know what you're seeing. Are you paring back investment, as the Beige book seems to indicate?
Well, I wouldn't say we're paring back investment, but we are more cautious right now. You know, last year we saw sort of gently rising oil prices for 9 months, and then they fell down. So our customers certainly are turning a more cautious tone, and our actions are always dictated on what our customer is going to do.
Do you think that we have this sugar high of rising prices? Some of that has to do with a non-OPEC member, and that is Russia. Now, their oil and energy minister, Alexander Novak, is somebody who has become extremely powerful, a voice when it comes to OPEC meetings. He shows up to every meeting, and people are watching what he decides to do as it pertains to output. How much of your day is used up thinking about Russia and its sort of role in this?
Well, they matter. As you said, Liz, they matter. Right now, the U.S. is the largest oil producer. Russia's number 2, and Saudi's number 3. And Iraq is a long-distance number 4. So Russia matters a lot, and there's different dynamics there than there is with Saudi. They're the 2 key players besides us.
What do you hope for prices? What do you think is going to happen here?
Well, my bet is oil prices between 50, So, you know, they were low to mid-40s a few weeks ago over Christmas, kind of spoiling my holidays a little bit. But, you know, we're low 50s now. I think oil in 50 to 60 range probably balances supply and demand okay. But, hey, markets don't always, they move on sentiment quite a bit. So we could spike above that. We could drop below that. But I look for oil in the $50 to $60 range this year.
All right, 50 to 60. And right now we've got crude at 52.37 in the aftermarket. So good to see you, Chris. Thanks so much.